Welcome, everyone. I'm Angelo Robles, and welcome to Family Office TV. And many of you know I'm also the founder of SFO Continuity and Family Office Masterclass. Today, supercharge multi-generational estate structures. It features a great guest who I've known for a long, long time. That would be Todd Angkatavanich. He's a partner at the iconic firm McDermott, Will, and Emory. A little bit of context, which is not doing it justice for Todd. He's incredibly accomplished. We're so fortunate. But a little bit. He focuses his practice on advanced wealth and succession transition planning. He regularly creates and implements wealth planning, investment structures to provide for the orderly and tax-efficient transition of family assets from one generation to the next, while providing for the effective stewardship of family assets for future generations. That latter comment, most attorneys often don't get, by the way. I've known Todd for coming up on about 17, 18 years. He's one of the most accomplished attorneys that we could talk to on this subject, and he does understand the dynamic of the greatest threat to the family effectively is the family, and stewardship and competency in the rising generation, and weaving in a program and estate planning that is more than just technically proficient, but has the generations engaged, involved, and could help to progress to lead towards, quote unquote, the ultimate goal, and really the ultimate goal of the work that I do with families, which is family continuity. I don't believe, since I left Family Office Association, and I've done probably 30 or 40 interviews on my platform now, that I've covered a subject that I think is so incredibly important. And that effectively is estate planning and wealth transfer. Again, many of you, I get it. You're focused on the investment aspect, which is very important within the family office community. But gravely underestimated are things with family and family governance, in tax issues, and in wealth transition. Yes, there actually is true alpha from talented individuals. This is not a commodity. At the highest levels that we're talking about today, someone like Todd and the firm that he represents is at the highest level of the work that they do. Now, it's going to be a bit of a technical discussion. We're not going to make it hyper technical. That could be a multi-hour discussion, perhaps for a point in the future. But it is going to be something that every family of wealth and single family office should be gravely concerned about. And yes, it is among the intellectual work that we do in my membership organization at SFO Continuity and the masterclass programs that I teach within that, my vertical of Family Office Masterclass, and having a Rolodex of great relationships like Todd and selectively others bring incredible content to my relationships. On that note, Todd, it's been too long. Welcome to the show.
Angelo, thanks so much for having me. Thanks for the kind words, and always nice to see you. Yeah, it's amazing how far back we go. I think it is 15, 16, 17 years or so. But great to see you.
Well, thank you. And you're reminding, I mean, my beard has grayed a little bit over the years since I had one. So you are reminding me my age, but it's okay, Todd.
And my hairline is thinned.
Well, you got a much better hairline than me, so don't make me too jealous. Before we get started, I will note to the audience, the views expressed are really, one, it's educational at the given time we're at right now. And I know it's hard to believe on estate planning and wealth transfer, but for entertainment purposes, you have your own advisors or will, and you have unique circumstances, meaning you, the audience, that is very specific to your liquidity needs, your risk tolerance, and currently your family situation, which is unique and dynamic and specific to you. This is broadly meant to be educational and broadly meant to be entertaining. And really important, we're recording this November of 2023. Things change rapidly in terms of regulation and to some degree in terms of the interpretation of a given situation or regulation at a given time. So again, you may hear this down the road and it is completely different, especially if it's a little further down the road. So unfortunately, this is one of those conversations, unlike family governance and unlike big picture best practices, that may not be that evergreen. Understand you must think for yourself, and at the end of the day, make your own decisions. On that note, Todd, why don't we get to it? So again, we're going to make the assumption that our audience has some fluidity on more of the basics of estate planning. Of course, we know that wills and living trust and all of that is incredibly important, but that's not going to be the subject of our discussion today. A lot of our families that are worth minimal, deca millions, often hundreds of millions, and we both really at our peak are dealing with a lot of billionaires. We don't mean that in an arrogant way. It's just a reality of how it worked out. And there are lessons that others could learn to a degree from that. So a lot of this may be more focused on certainly much larger scale families. We do know here in the US, and this will be more of a US centric discussion, do you understand that as well? That there is something called an estate tax. It kind of means that as a family of wealth, to a degree, you have a bit of a silent partner in the US government, the IRS, that is going to take a lot of your wealth if you don't properly plan for it. Why don't you lay the foundation of the estate tax and what some of the exemptions are currently?
Sure. Well, so let's get started here, Angela, right? So, we've got basically an integrated transfer tax. When we talk about transfer tax, we're talking about estate, gift, and generation skipping taxes. And, the rate is generally 40%. And, the estate tax is imposed obviously on the assets that are in your estate at your passing, as well as some assets that you've perhaps attempted to give away, but perhaps might still be included in your estate under certain what we'll call strings provisions. The gift tax is also imposed at 40%. Okay. And that applies with respect to gifts that you make during your life. Now, there is a unified exemption that applies, so that if you use some of that during your lifetime, okay, what's left at your death, you can still use. Okay. So right now, that is $12.9 million and a little bit of change for this year. It's going to be inflation adjusted. It's going to go up to $13.6 million next year. Then the year after, in 2025, presumably it's going to go up again, probably over 14 million. And then the way that the law exists right now, it's going to sunset at the end of 2025. And we're going to go back to these older exemptions, which was $5 million indexed for inflation. So right now we have sort of a unique period of time. We'll sometimes refer to that as the bonus exemption, the bonus gift tax exemption, for us to use or lose before the sort of law sunsets and the values or the exemption amounts go back down to the $5 million adjusted for inflation. Now, I'm going to be dating myself here, Angelo, and I'll probably be dating you too, just for how long we've known each other. But when I first started practicing law, the exemption was $600,000.
I remember those
it up at 625, 650, all the way up to $1 million, then to $5 million. And so now we're in a situation where those exemptions are about 20 times what the lifetime exemption was during, when I first started practicing law. Right. So these are very sort of unique times. These are very generous amounts of exemptions, but they are here for a limited period of time before they go back down to $5 million adjusted for inflation. That's assuming that the law doesn't change before the sunset occurs. Now, in the case of, many families, we are using that exemption, and that's a start. And, for many people, that can cover everything, right? But when you get into dealing with a lot of the larger families, using the $12.9 million exemption, let's just say 13 to round it up, $13 million. If you double that up by having your sort of spouse join in on that gift, you can give $26 million. Now, that's a lot of money, right? But for a lot of the families that we work with, that is not going to make a really meaningful difference in the overall sort of wealth transfer planning unless we do some other things. And that's, a big focus of what we're talking to families about right now.
Of course. And a little bit the direction that I headed in some of my commentary. Again, I get it. Investments are very important. But if you don't do planning, if you're just relying on you and your wife's exemption and you're an ultra high net worth person, look at the significant amount of taxes you'll have after that about 26 million that's exempt if you don't do any planning, which is why the alpha for proper estate planning is incredibly important, especially at, I would say, under $1 billion. And then it becomes more complex, and there's different nuances for what I would define as multi-billion to even deca-billionaire families, and things that we'll touch on a little bit today as well. And again, we're trying to keep this more mid to high levels, so there are some things that we'll be kind of skipping over a little bit. Otherwise, also, it could be a 3-hour discussion, which I'm down with, but, Todd has a busy schedule. How would you define, would there be maybe a big 3? And if you want to make it 4, it's okay. We could even make it 5, that wealthy families should look at in terms of helping to mitigate some of the quote unquote estate tax that we're discussing today?
Sure. Well, I think when we start getting into some of the other applications, this is assuming that we use up sort of, let's say, the $13 million of exemption, right? So if you want to just do a straight gift with easy to value assets, cash or marketable securities, you can do something like that into a trust, apply generation skipping tax exemption to that, and make it multi-generational. That's nice and simple, right? Nice and straightforward. But again, that only gets you so far when you're dealing with assets that are, in the hundreds of millions or getting into the billions, right? So again, those are very valuable exemptions. But the name of the game with all this kind of planning is to sort of build upon what you've done before, build upon, with doubles and singles, right? Sometimes I like to think about this, Angelo, as sort of ways to add a little bit more octane into the structure. Now, the big 3, we sometimes refer to them as freezes, freeze planning. And why do we call it that, right? Because what you are trying to do is freeze the value of the assets so that the future growth doesn't occur in the, let's say, parent's taxable estate, right? And you want to shift that growth into something that's going to be outside of the parent's estate. I often like to use the analogy of buckets. So I'll often say a red bucket, meaning that's the bucket that you don't want to grow. You don't want to fill that up. So classic red bucket is maybe parent individually, right? Because their assets are going to be subject to 40% estate tax when they die, right? So that's a classic red bucket. You don't want to grow that. Classic green bucket might be, let's say, a dynasty trust that's exempt from the generation skipping tax that will go from generation 1 to generation 2 to generation 3 and so forth, and not receive that 40% haircut at each generation. So when we're talking about these buckets, the classic red bucket and the green bucket one that you want to grow, that's a good analogy for talking about the big 3 in terms of the different most popular kinds of freeze plans, right? One of the ones that I like a lot is called the sale to the grantor trust. Right. So let's say, for instance, I have made a gift of $13 million into a trust, and that trust is multi-generational. So it's generation skipping tax exempt. I've applied my $13 million generation skipping tax exemption to this trust, and maybe I've set it up in a state like Delaware or South Dakota where you can create it and it can be perpetual, meaning that it's not going to receive that 40% generation skipping tax haircut at each and every generation. Now, again, I put $13 million into that using my gift tax exemption. That's great. And it's multi-generational generation skipping tax exempt. But if my assets are, $200 million, $500 million, more than that, what else can we do to kind of keep building up and grow, fill up more that green bucket generation skipping tax exempt multi-generational trust? Well, I've done my $13 million gift. Maybe I can loan additional assets. The rule of thumb is maybe 9 times what I've put in there. Or better yet, maybe I sell additional assets into that trust and I take back a promissory note that imposes interest based upon the applicable federal rate. Now, that allows me to get, let's say 9 times that 13 million into that trust growing, and I'm taking back a promissory note in that same amount. So what I'm doing is I am taking back the promissory note that's still going to be included in my estate, but I've transferred over assets that I've sold into that dynasty trust. Now, perhaps I've sold that, taken a valuation discount to reflect the fact that the asset that I sold is maybe non-voting units in an LLC. right? So maybe I've been able to get out even more assets into that trust. And then now if those assets grow, but my note stays the same, what I've done is I've shifted over this future growth into this multi-generational dynastic trust. So now over time, hopefully that grows and grows and grows. And over time now I've built up maybe 200 million, 300 million or so in that trust. That's the sale to the grantor trust. And one of the benefits of that is not only can I shift the growth into that trust and get it outside of my estate and make it multi-generational, but because that trust is often intentionally created so that it is my alter ego for income tax purposes.
Yes.
What that allows me to do is sell the asset, which might have appreciation, sell it to that trust, take back a promissory note. But because it's my alter ego for income tax purposes, it's called grantor trust status, I'm not going to trigger an income tax gain on my sale of assets into that trust. So now I've got all these assets growing in this trust, and I've contained the value of my estate to the value of the promissory note. So that's kind of the one that I like the best. It's called the sale to the grantor trust. There's a second one, which is called the grantor retained annuity trust. It's a GRAT. And this one is sanctioned under the tax code, section 2702 of the tax code. We're not going to get into a lot of code sections, but that is one that is sanctioned under the tax code. And it involves me making a transfer of assets into that trust, taking back a fixed term annuity stream. And the tax code allows me to say, okay, if I have made a transfer of assets into that trust of, say, $10 million worth of assets, and I take back an annuity stream for a selected term of years, and the present value of that annuity stream basically equals that $10 million that I've put in, tax code says that I've made a gift of zero, right? Why is it a gift of zero? Because I put 10 million of assets into this trust and I've taken back an annuity stream worth $10 million. Now, the assets, though, that I've put into this trust, if they grow, all that future appreciation is going to be outside of my estate. All I've taken back is this annuity stream worth the $10 million. But if the $10 million assets that I've put into the trust grow to 20, that $10 million of appreciation is excluded from my estate. And so I've been able to transfer this gift tax-free into this trust and get those assets out of my estate. There's a third variation, Angelo, called the preferred partnership, which is, I sometimes like to think of these different freeze transactions as flavors to sort of keep that analogy going, right? And so if your sale to the grantor trust, the first one is maybe a chocolate chip mint, right? And your GRAT transaction is maybe a rocky road. The preferred partnership has more going on. It's sort of like a Ben and Jerry's fish food, right? Or a Chunky Monkey. It's more expensive. There are more ingredients, probably a little bit more uncertainty about what you're going to get, more moving parts, that kind of thing.
This is why my favorite ice cream, Todd, is still vanilla. Maybe I'm a boring guy.
That's right. Well, that would be, to take that analogy further, that would be your straight gift of cash into one of these trusts. Right?
Yeah, exactly.
No moving parts, right?
I'll talk a little bit about preferred partnerships. And as I remember, they're a wonderful tool, but they could get deep behind the scenes on the taxation, the implications, how they have to be structured.
Sure. So the preferred partnership is this kind of third, more exotic kind of freeze, if you will. I will say that I usually don't really get into the preferred partnership unless and until we've already exhausted the idea of, the sale to the grantor trust, and if you've exhausted the idea of the GRAT, right? So it's a third kind of freeze. There's more going on with it, but essentially what we're doing, and there's a little bit of a misunderstanding out there. Some people will say, well, you can't do a preferred partnership in a family context because of Chapter 14 or specifically Section 2701 of the tax code. That's not true. You still can do a preferred partnership nowadays, but they have to be done in a very sort of specific way. But what it involves is basically you have an LLC or a family partnership or a corporation even, and it's restructured into two economic classes. So you'll have a frozen cash flow preferred interest, which is going to entitle the holder to a fixed percentage based upon their capital contribution, let's say, for instance, 8% in the current environment, they'll also be entitled to a liquidation preference, right? And sort of that gives them that more secure priority cash flow interest. What they sacrifice, though, is that the common second economic class of interest, the common interest, is the growth interest. And so that's going to be a longer term investment, right? That's going to be riskier. And so what you're doing with a preferred partnership is you are really making a decision up front to divide the economics of this partnership or this LLC into two different classes: the frozen cash flow class, preferred, and then the common growth class, right? And so that actually lends itself well in the family context, where maybe you have much different sort of liquidity needs. Maybe the senior family member wants more liquidity. They want more stable cash flow. They are willing to forego the upside growth potential in exchange for less risk. On the other hand, maybe child, or better yet, maybe one of these multi-generational dynasty trusts that we've created, maybe that trust has a much longer investment horizon. Maybe it has more of an appetite for risk. And so this is really kind of a division of the economics between a cash flow and a growth interest. Now, there are applications, Angelo, that we often use this with, not just between sort of the individual parent and child or child's estate, but maybe we'll apply it with different entities. So maybe we have different trusts that are less efficient and more efficient, and maybe those might be good candidates to participate in one of these preferred partnerships, again, in order to shift the growth out into the more efficient, longer term investment bucket, let's say this green bucket dynasty trust, while at the same time sort of giving the more secure cash flow, but not the growth, into a different bucket that might be shorter term, for instance, a GST non-exempt trust.
Yes, and that probably segues to me a little bit into, and I think you hinted at it a little bit, the chapter 14, quote unquote, minefield, which maybe for the purposes of our podcast today, we addressed lightly enough, but if you wanted to add to it, that's fine. But I guess it's hard to have a discussion about the more complex preferred partnerships without talking about its relative FLPs or family limited partnerships and a little bit about section 2036, if you don't mind.
Sure. So family limited partnerships, sometimes referred to as FLPs, these have been around for, several decades now, right? And they really became sort of popular in the early 90s. And it's something that I think we see most families have some kind of family limited partnership or LLC in place, right? They were often created with marketable securities, often created with other types of assets. And it's a way to sort of, accomplish a number of the different family objectives, right? Having a place to sort of consolidate investments, having a way to sort of manage investments, having a way to build in succession. And, there can be some tax efficiencies with these too, right? So, the tax court has made clear that, if I'm transferring assets, if I'm transferring interest in, let's say, a limited liability company or a limited partnership, and those are non-voting interest, non-controlling interest, if I give a 10% interest in that company, whether it's a family partnership or an LLC, down to my kids or a trust for my kids, valuation discounts may apply for the fact that it's non-controlling and it's not marketable, right? But that's kind of there's been a back and forth on family limited partnerships over the years between taxpayers and the IRS. And it's a constant evolution, right? But I think what has sort of been clear from the cases over the past couple decades is that, the IRS, sometimes will challenge these things. And I think it's sort of a simple way to look at it that, well, the IRS doesn't like discounts. Taxpayers do like discounts. And that is very true in some cases, right? But there are a number of situations where actually the IRS will try to affirmatively apply a valuation discount in certain cases to reduce down, let's say, the estate tax marital deduction that the estate's entitled to, or perhaps try to reduce the amount of the charitable deduction that an estate may be entitled to. So it's not really true that its valuation discounts are sort of favored by one and not favored by the other. Now, what we have a lot of times, though, are situations where parent has created a family partnership or a family LLC. Maybe they've gifted non-voting interests in that entity, or made a combination of a gift and maybe a sale transaction in connection with that promissory note that I first talked about, and they got those assets into a trust, right? And the assets should hopefully be outside of the parent's estate. The IRS, in their sort of ongoing challenge under different theories of family limited partnerships, has had the most success over the past, numerous years in challenging these vehicles under Code Section 2036. Code Section 2036 actually had nothing to do with family limited partnerships, but it's sometimes referred to as the retained strings provision, which basically says, the tax code says, look, if I give away something, I have to really get rid of it in order for it to be outside of my estate and not come tumbling back into my estate when I die. However, this Code Section 2036 says that if I give an asset away and I retain either the right to use it, either expressly or even through a wink, wink, nod arrangement, or if I retain the right to control the disposition of it, retain the right to control who's going to enjoy the asset that I've given away, either of those two kinds of strings can be enough to pull those assets right back into my estate for estate tax purposes at my death. Importantly, at the then appreciated value, right? So this can lead to a significant whipsaw, because maybe you have your spreadsheets and you have, okay, we've given away 25% of the partnership away. That should be in the column that's outside of my estate. And maybe, okay, I've held on to 75%, and that's in the column inside my estate. But if this 2036 application is successful by the IRS and they're able to pull the assets back into the estate, what do you have? You have 100 still included in the estate for estate tax purposes. That's phantom estate tax, right? But you've given away 25% already for property law purposes. And that can lead to a big mismatch. It can lead to all sorts of estate tax issues and problems, right? So the IRS's sort of continued sort of challenge of different family limited partnership structures under different theories is something that's been an ongoing evolution for the past several decades, really. And there's been a real focus over the past couple of years in this notion of control, right? So did the parent continue to have too much control, either in the capacity as a manager of an LLC, or as the general partner, or as one of the partners or one of the owners of the general partner in a family limited partnership? And can that control be such that the IRS might be able to argue that the assets should come back into the estate? Now, there's been a back and forth in the tax court on this, right? Because there's a relief valve there, right? So if the parent has too much control, arguably, there's another line of cases that says, yeah, but if the parent is subject to real fiduciary duties, okay, that should block that inclusion back into the estate. And so what you have is a push and pull here of different cases and different theories being sort of proposed by the IRS and counter theories being proposed by the taxpayer. One last thing I'll say is another way to address that, and this is all sort of a number of different factors that are floating. There's not sort of a sort of magic bullet in my estimation, and I think it also is going to depend upon the comfort level of the client, what they're willing to do. But one thing to consider also is the bifurcation of managerial duties.
Yes.
Right? So let's say you have the parent as the manager of an LLC. A lot of times, if the parent wants to continue to have influence, it's more so the ability to select investments on behalf of that family entity, and less so the ability to control when and how much distribution is going to be made from that family partnership or that family LLC. The kinds of powers that is more problematic in these cases is the distribution power, and a lot less so the power to make investments. So sometimes we'll do a bifurcation of these managerial duties where the parent is going to hold on to the right to direct investments on behalf of the entity, but maybe someone else has the power to direct distributions out of that entity. There's a whole sort of additional sort of layer of evolution to this that we don't have time for today. But I think it's just important to note that that is something, and it's important to really kind of conduct occasional stress tests on your family vehicles, whether it's a family limited partnership or a family LLC, right? Because there's no sort of bright line test that you can say we necessarily sort of are going to satisfy some of these exceptions, or if we're going to fail it. But the best you can do is really do a periodic stress test.
Which relates to probably two comments I have, one specifically related to that, and then one not. And I was just going to say, so your timing is perfect. By the way, if you had an estate plan done, even if it was wonderful, and by the way, I would ask you, how would you quantify that? Are you a high-level estate planning attorney yourself? It's like asking someone, give me a referral to a dentist. But what makes you qualified to recommend your dentist to me, other than your qualitative perception of you like him or her? Therefore, my bigger picture point is you might have had an estate plan done, and it may be good, it may not be good. I do not know. But what I do know is, why are you not having it reviewed? Because so many things change. It likely may be dated, or conditions have changed, perhaps financial, perhaps legal and regulatory. There's so many reasons why that at minimal, you should at least lightly look at it annually, and probably significantly upon any major IRS change relative to the issue of estate taxation and taxation in general. And broadly, a deep dive, I would say every 3 years, and then probably have a reviewer review the review that the person, that's the core that you're using. In other words, have a second, if not third set of eyes. Does that mean it's going to take more time and cost more money? Yes, but this is so valuable. And again, we're now finding out, among the many reasons why most families of great wealth, the wealth does not last potentially as long as it could. The other comment, I know I have a strong audience over the decades in New York and Greenwich and Silicon Valley, a fair number of significant GPs and hedge funds, venture capital and private equity. This absolutely all applies to you, but we have some specific stuff towards the end of the interview today that will be very specific to people in that sort of scenario. So stay tuned. I did not forget about you. Todd, maybe a little bit of a step back, but we're using some pretty big words and some pretty complex things we're talking about in a variety of ways, from FLPs to preferred partnerships to even GRATs. There may be a little bit of a misunderstanding relative to what is a generational skipping trust and what does it mean to be dynastic and exempt generation after generation. If you could maybe just a little bit bifurcate a word you used before, a little bit between the advantages of being truly an exempt dynastic trust.
Sure. So at the top of the discussion, I had mentioned, you've got the three different transfer taxes and their exemptions, right? You've got the gift tax, you've got the estate tax, you've got the generation skipping tax. So let's say, for instance, if I make a gift using my $13 million of gift tax exemption, 12.9, but let's say 13 million, and I put it into a trust, right? That trust can be either generation skipping tax exempt or not exempt, right? And if it's not exempt, right, let's say that $13 million will go into a trust for the benefit of my children, and then it grows from 13 million to whatever, 50 million over the course of their lifetime. That GST non-exempt trust, when my children pass it on to their children, will be subject to a 40% generation skipping tax at that time, despite the fact that it went in there gift tax free, right? Now, if I create that trust so that it doesn't pour outright at my child's death to my grandchildren, right? But rather it goes for my child's lifetime, and then at his or her death, it goes on for further trusts for their children and so forth. That's going to be something that's sort of a multi-generational trust structure. And in that case, what I want to do is I have this valuable $12.9 million generation skipping tax exemption as well that I can apply to the right trust. So if I've made that $13 million gift into a trust that doesn't go outright to my grandchildren, but continues to go on through the life of my child and my grandchild and my great-grandchildren, that's going to be a really good candidate for me to allocate $13 million of generation skipping tax exemption to that trust at the same time that I've made that gift of the 13 million. So to use that green bucket analogy, now it's a GST exempt multi-generational trust. It's dynastic because it's going to go on for multiple generations. That's your classic green bucket trust. That's the bucket that you want to fill up. Again, I'm the classic red bucket trust, right? Because my assets are going to be subject to 40% tax when I die. The assets that I put into this green bucket multi-generational dynastic GST exempt trust, once I put the first amount in there, the 13 million, using up my gift tax exemption, and I apply my $13 million of GST exemption to it, now it's just going to grow and go from one generation to the next, to the next, to the next without a 40% tax under the current law. Now, I should say that there have been some proposals over the years which would have some limitations on how long these things can last, right? And what's interesting is some of the proposals in the past would have said, well, okay, if you have a pre-existing grandfathered GST exempt trust, then that's still going to be okay. But only new trusts after any change of the law would be subject to a period of 3 generations, for instance. Some of the more recent proposals would have actually said, even if you have a grandfathered multi-generational GST exempt trust, we're going to put some natural limitation of 50 years or so to how long it can last before it will become taxable again. But at least as the current, state of the law exists, and it's existed for a long time, we can create these GST exempt dynastic trusts, and then they are not going to be subject to the 40% haircut at each generation. Those are the kinds of buckets. That's the kind of classic green bucket that we want to try to shift as much growth as possible into those trusts, again, to avoid the 40% haircut, while at the same time containing the growth in the less efficient red bucket. Now, one red bucket, I said I'm the classic red bucket, right? But there are other kinds of red bucket trusts as well. For instance, a GST non-exempt trust, the first one I talked about, right? Because that's going to be subject to a 40% haircut when my kids die, and then 40% when my grandkids die. So if we can find ways to shift over more growth into the GST exempt green bucket trust, that can make things very powerful and can elongate sort of the multi-generational wealth sort of preservation planning in place. And we can go into, there are a bunch of different ways to sort of leverage that up.
Yeah, we're trending in that direction, but relative to what you said, and you did hint at it earlier, it's important to understand, the rule perpetuity limitations, or the rule that there is no quote unquote rule against quote unquote perpetuities. So understanding here in the US, the situs, the domicile of a specific trust. I could think of certain states from a privacy and a tax perspective that tend to be more favorable: Alaska, Wyoming, South Dakota, Delaware, New Hampshire, and there are others. But how would you say for a family that's had a trust in existence for years or even decades that is not in a favorable situs, how complex is it to change the situs of a trust?
Some of the things that we usually try to think about when we're dealing with older trusts, and, like you said, Angela, some of these trusts, it's not uncommon to see trusts that are 70, 80 years old. And at the time when they were created, these sort of more multi-generational dynastic trusts were just not the kinds of things that were really done, right? And so it's not uncommon for us to see trusts that are, hundreds of millions or perhaps billions of dollars that are subject to a rule against perpetuities, and they are going to end at some point, and all the assets are going to be coming, get kind of flushed into the tax system. And so what we try to do in that situation is try to figure out well in advance, right? It's very unlikely the case that we're going to be dealing with a situation where, okay, this thing's going to end in, 2 years or so. It's usually the case where, when you've got, 5, 10, 20 years or more to plan in advance. This all goes down to that bucket concept, right? So some of the things that we might think about, let's say you've got, a trust that's going to end in 20 years or so, and you've got a current sort of generation of beneficiaries. maybe those beneficiaries have not used up their exemption yet, right? So far, Angela, we've really talked about generation one, the wealth creator. Okay, we want to use their $13 million exemption each between, spouses, so 26 million, and then leverage that up with some loans. But don't forget, now we've got maybe these other next generation beneficiaries of that trust. Maybe they're in their 20s or their 30s, Angelo, right? Where they're not really feeling so liquid. They're not really feeling so wealthy. But yet we know that they each have these valuable $13 million exemptions going up to 13.6 next year, right? And so before we kind of have the sunset of these bonus exemption amounts, what can we do in order to try to think about, planning for the next generation or next generations to use up their exemptions to create as many of these green bucket multi-generational vehicles as possible? One way to think about that is, maybe distributions can be made out of these perpetuities limited trusts in certain amounts that could be in the hands of those next generation beneficiaries. And those next generation beneficiaries can do their own planning to take advantage of their own $13 million gift tax exemption and GST exemption. Maybe they can even leverage that further by receiving further distributions out of that perpetuities limited trust, maybe making additional sales in exchange for promissory notes. So now you only, now at the Gen 1 level, you have some dynasty trusts that have been created. At the Gen 2 level, maybe you have some dynasty trusts that have been created. And what you're doing overall is you're increasing sort of the base of these green bucket trusts that are going to be tax efficient and last for multiple generations. And you are minimizing or hopefully containing sort of the eventual tax hit, the 40% hit that's going to happen with that red bucket trust. There are more ways to leverage that up further. For instance, maybe now what you have, Angelo, is you have, this red bucket trust that's, let's say, limited by the rule against perpetuities, or maybe it's one of these GST non-exempt trusts that has substantial assets in it. And now we've created a bunch of these green bucket GST exempt dynasty trusts. Maybe those trusts can contribute assets into a common partnership or a common LLC in exchange for, and we create that as a preferred partnership. So now this red bucket trust is going to take back a more secure priority cash flow preferred interest, and the green bucket trusts are going to take back the growth interest. Now you've got this red bucket trust that's going to receive an annual cash distribution of those preferred interests or that preferred coupon, and that could be used for the spending needs of the current generation while continuing to shift the growth in that more multi-generational efficient green bucket trust, or actually multiple green bucket trusts at that point.
Yeah, I mean, again, this is a complex picture in terms of the issue with transfer and estate taxes, and absolutely a big part of it is quote unquote science, and some people are simply better at it than others, but there's definitely some art to this as well. That could be a combination also of what some people define as up generation planning and what you just noted, more applicable, probably down generation planning. We didn't talk about, probably because it's a little bit more on the basic to lower medium side, but probably not to be ignored, the value of leverage and the potential of life insurance. Henceforth, putting it within an irrevocable life insurance trust, an ILIT. We don't got to get into the granulars of crummy powers and all that wonderful, exciting stuff. But nonetheless, I'm assuming at least up to a certain point, because there are limitations on insurance, and that also assumes that someone is even insurable. As they get older, that becomes more challenging, and the leverage is not going to be quite as strong. But I'm assuming maybe more in the earlier stages, you do look at the full insurance picture and ways that they can maybe leverage or optimize that as well.
Sure. And, I'm not an insurance advisor, right? And my view on insurance is, it's an important sort of element. It's an important sort of tool in the toolbox to be used as part of the overall planning. But I'd say, at the very least, when you're evaluating, the different assets of the family members, make sure that you don't have any of the insurance policies that are individually owned by them.
Exactly.
If you do, try to get those into an insurance trust, right? If you don't, then the death benefit value is going to be included in the estate of the insured. And even if you have sort of a marital trust that's going to allow the surviving spouse to receive it estate tax free, now the surviving spouse is going to be saddled with those assets included in his or her estate at death, right? So obviously you want to try to move those out of the estate. Be mindful of the 3-year rule under Section 2035 to get rid of it, right? But I think more broadly, some of these whole leverage ideas that we're talking about can be also, used as a way, or perhaps in part a way, to fund some purchase of life insurance. So let's say, for instance, you have one of these trusts and you've done a gift into it and you've done a loan into it in exchange for a promissory note. Maybe some of those assets can be deployed into insurance, right? Whether that's sort of whole life insurance or term, or maybe, private placement life insurance. Different families are looking into that as different ways to make sort of tax efficient investments. And if you do it inside of a trust, that could make it estate tax efficient as well.
No question. I'm a big advocate for those families with complex alternative investments for consideration of the value of private placement life insurance, and to somewhat of a lesser degree, but still valuable, private placement variable annuities as well. Again, everyone's situation is different. There are some, not many, real true professionals in that arena, and they absolutely should be utilized as part of the big picture. In that case, really combination of investment, estate, and to some degree, asset protection planning as well. I think I'd also be remiss if we didn't bring up, on somewhat more of a middle level to advanced concept, if you could describe and illustrate the value of a Q-tip.
Sure. Well, us as estate planners, everyone loves their acronyms, right? GRATs, Q-crits.
I can imagine what some people are thinking when I said that. Yes.
Flips, everything's an acronym, right? But the Q-tip trust, it's just based off of the words of the statute under 2056, qualified terminable interest property trust. In short, what it is, it's a trust that one creates for the benefit of their spouse. Has to be a U.S. citizen spouse. You can create it during lifetime. More typically, it's created in one's estate plan, and it's estate tax neutral, right? So rather than, let's say I'm worth, $100 million and I'm not comfortable giving, the balance of my estate over my exemption outright to my spouse, right? I can put it into a trust, a marital trust called a Q-tip trust. And that's going to sort of be treated for estate tax purposes, essentially the same as if I gave it outright to my U.S. citizen spouse. So in other words, it satisfies or qualifies for the estate tax marital deduction. So let's say I've got, $90 million of assets going into a Q-tip trust for the benefit of my spouse at my death. That's going to not trigger immediate estate tax. Okay. But that trust is going to be there for the benefit of my spouse. It has to provide sort of mandatory distribution of income to my spouse each year. I can include in there for discretionary distributions of principal. And then the benefit of that trust is it's going to control where it's going to go at the balance of my spouse, or at the end of my spouse's life. So I can control that it's going to go, let's say, for the benefit of my kids when my spouse dies. From an estate tax standpoint, it's not going to be subject to estate tax at my death because it will be entitled to the unlimited marital deduction for assets going down for the benefit of a spouse. Angela, I'm sorry, one sec. Can you? My daughter is singing. I'm sorry.
It sounds wonderful.
Yeah, I'm doing a recording. So sorry about that.
We both have home offices. That's part of the natural charm. And her voice sounded amazing, by the way. So it improved. It made it better, Todd. You and I are two droning on about a complex subject that added some spice to it.
So where should we pick up?
Well,
I would like to talk about a little bit of the planning that you can do with the Q-tip.
Yes, and that's why I did bring up the Q-tip. So please
Great.
continue about some of the additional planning.
Okay. So I guess we'll insert here. So the Q-tip trust will allow you to control the disposition of the ultimate distribution of the assets in that trust at the death of the surviving spouse. It also qualifies for the estate tax marital deduction, but that is just kicking the can down the road from an estate tax standpoint. Because if I leave that $100 million into Q-tip trust for my spouse, when she dies, okay, it's going to be included in her estate for estate tax purposes at her date of death value. So if I put 100 into it at my death and it grows to $200 million by the time my spouse dies, the 40% tax or whatever the estate tax rate is at the time is going to be based upon the $200 million appreciated value. And so we sort of have situations a lot where we're dealing with estates where there are these very large Q-tip trusts in place, but they are also, to go back to the other analogy, Angelo, it's another kind of red bucket trust. Why? Because if I put the 100 million in there and then it grows, the 40% tax is going to be imposed upon the death of my surviving spouse, right? So there are some things that we could think about doing, and none of these things none of these things are free of complexity, right? There's a lot of tax wiring under the dashboard for all these vehicles. But one idea is, well, why don't we take that $100 million Q-tip trust and invest that into an LLC or a family partnership? Maybe we take back preferred equity interest so that there's a preferred return being paid to the Q-tip trust. And the Q-tip trust has to make the distributions of income out to my surviving spouse. Maybe that dynasty trust that we created for the kids can invest cash into this preferred partnership and take back the common growth interest. So now, again, over time, what we're doing is we're containing the growth of this Q-tip trust, which is going to be subject to estate tax when my spouse dies, and we've shifted over the growth into the more efficient green bucket dynastic trust. Right, so there's a real sort of, there's a common theme to a lot of the ideas that we're talking about, but it's really selecting sort of the right place to grow your assets and having a protocol to do so. I would say, with all these, with the preferred partnership, with the sale to the grantor trust, with all these different vehicles, there's, a lot of devil in the details. There's a lot of tax wiring under the dashboard. I mean, you were sort of mentioning before the necessity for stress testing occasionally, and I couldn't agree more with that, because all these things have their soft underbelly issues. All these techniques have their relative pros and cons. What might fit for one client may not fit for the other client. It really depends upon the appetite for certainty, uncertainty, and complexity. So a lot of different moving parts, but all these things have their soft underbelly issues that can cause them to have problems if they're not done correctly. In the case of the Q-tip trust, one of the very important issues, if you're going to do any kind of planning with a Q-tip trust, is this section 2519 of the tax code. What is that? Well, I mentioned before that the benefit of a Q-tip trust is that I can put the $100 million into it at my death, and it's going to defer the estate taxes until my spouse dies, right? It's a kicking the can down the road, and we're allowed to do that because, well, the spouse is going to be receiving the mandatory income for his or her life, and then, can receive discretionary distributions of principal. But, there's a gift tax provision under 2519 that says, hey, if the spouse, however, gets rid of that income interest during his or her lifetime, then he or she is not really being the main beneficiary of this trust anymore. And so essentially, they shouldn't be able to continue to enjoy that estate tax deferral that was obtained when the trust was first created upon my death. And the way the provisions work, it's through an imposition of a gift tax under section 2519. And that basically says, look, if I dispose of my income interest or a piece of my income interest in this Q-tip trust, then all bets are off. And we're going to basically cause a gift under 2519. It's actually a couple different components to it, but it's basically an acceleration of that deferred estate tax. And so whenever we're doing any kind of transaction, let's say if we're going to have the Q-tip trust invest let's say in a preferred partnership or just a straight up and down family limited partnership, we need to be mindful of the fact that, if they're not getting full value for that, there might be some challenges that could happen under 2519. There's actually a bunch of different authority out there that's on point with that. And there are ways to do it. But again, there's a lot of sort of tax wiring under the dashboard that you need to think about.
A lot. And, we certainly went into some topics broadly in wealth transfer and estate planning that could apply to people that are really the super rich at the highest level. And then, we touched upon a little bit, even supercharging per our title, FLP distributions to a child, and the child places it into a GST. We didn't talk too much, again, more acronyms, but a holdco, a holding company, and how to structure that, non-voting shares. So I don't know if you want to kind of put a bow on some of the advanced level, quote unquote, supercharging strategies that can lever up even more, using opportunities for down generation planning with FLPs and holdco, or AKA holding companies.
Yeah, I think we've touched upon sort of a bunch of these different concepts here. I think that the down generation planning is something that I think, so we've got just about 2 years, a little bit more than 2 years before the sunset of the bonus gift tax exemption amount, right? So there's some lead time to be thinking about, some planning with the next generation to take advantage of their exemptions. I think the important thing is that's something that takes a lot of lead time to socialize that kind of idea, right? Because, the next generation, maybe they are beneficiaries of large trusts, but they don't really feel so liquid. And so if you're saying to a 28-year-old next gen beneficiary, okay, well, you should make a $13 million gift, or you and your spouse should make a $26 million gift, that makes for, a pretty interesting Thanksgiving dinner conversation, right? As we're going into Thanksgiving week this week. So I think, it's important to kind of think about sort of how to have this discussion, think about funding mechanisms, right? Just trying to figure out ways that those, those valuable exemptions can be utilized before the law changes. Same thing with up generation planning. Let's say if I'm the wealth generator, right? My parents have some assets, but they don't have the kinds of assets necessary to utilize those exemptions. Maybe there are ways that you can do some transfer planning, maybe with loans or with grats. Sometimes I'll call them upgrats, in order to get assets up to the generation above me, so that they have assets that are available to soak up their exemptions as well. So there are different ideas that you can do to leverage up and leverage down. But I think the important thing is, we're just over 2 years out on this exemption. These things take some lead time in order to get the structures in place properly.
Yes. In other words, certainly, as you're hearing this, get started. In terms of, we're going to take it to the home stretch, and I promised my audience of people that are maybe active in carried interest situations, GP/LP interest, venture capital, private equity, hedge funds. I'm, still active in one of my backyards in Greenwich, Connecticut. So obviously that's a big thing there. There are levels of highly advanced planning, even above and beyond some of the things we're mentioning here, because this may apply more within their carry or their fund structure, from vertical slice planning, non-vertical slice planning, derivative strategies, ground floor opportunity planning, dealing with valuation on uncertainty issues, price adjustments, formula clause. Now, again, we could probably do a whole program just dedicated to this, but putting a little bit of a bow on it among this niche within, quote unquote, the super rich, what would be some additional work among what I said that you would weave into their planning?
Sure. So, I think I like to explain things using analogies a lot, right? And so a lot of the things that we've talked about so far, the planning, wealth transfer planning objectives, right? Maybe that gift into the dynasty trust, maybe leveraging it up with a note, maybe a grant or retained annuity trust, right? Some of those structures, those are the very structures that we often use when we're planning with founders of a private equity fund or a hedge fund or a venture capital fund. And, that's sort of the base objective. But there are all these other rules that sort of layer on top, specialty rules and issues that need to be coordinated in order to be able to achieve that sort of base level objective. I sometimes sort of analogize this to, let's say if our base objective to do this planning is the City of London, then you've got these sort of crazy amorphous rules, which is basically like, Hogwarts, and the crazy rules that just layer on top of it. Okay. And a lot of that's under Chapter 14 of the code. A lot of it is that Section 2701 that can frustrate sort of the more straightforward objectives. And, so let's say if we have a fund principal and they've got carry and, it's a 2 and 20 structure. When we're doing this kind of wealth transfer plan in general, I think it's apparent from these discussions that we want to plan with the asset that's going to have the most upside appreciation potential, right? Because if I transfer it out at this value, the gift tax is imposed at this value generally and not imposed on the future growth, right? So that would lead us to conclude that, well, what has the most, upside growth potential? Well, it's my carried interest in my fund, right? So if I had my druthers, I would just want to try to figure out a way to get the carried interest into one of these multi-generational green bucket dynastic GST exempt trusts. However, some of these crazy rules of Chapter 14, these Hogwarts rules, can frustrate things. And it can basically cause a different kind of deemed gift tax to apply if I just give away, let's say, just my carry in my fund, and that's a subordinate equity interest. And even though the gift tax is generally imposed based upon this level, these crazy Hogwarts rules could sort of impose additional deemed gifts on transfers that I make, even though the value might only be like that for fair market value purposes. There's a lot of sort of obscure provisions that you have to deal with that. But I'd say, the sort of most elegant sort of planning solution that is usually done probably 90% of the time when we're dealing with fund principals is the so-called vertical slice. And what that means is that if I'm the fund principal and I have, my interest in the GP with the carry, and I also have other equity interests, either through the GP or, capital interest in the fund, this vertical slice approach will say, look, if I'm going to give a 10% reduction of my GP interest, I also need to give a 10% reduction of my LP interest. And like a slice of cake, that will be one of the exceptions to these, potentially thorny draconian rules. There are other approaches that we call non-vertical slice approaches, right? That we can get, they get a little bit more exotic as different ways to do planning in the situation where we think the vertical slice is going to be too limiting. Well, when might the vertical slice be too limiting, right? Well, Angela, if you and I just start our fund and it's our very first fund and the carry has a very low value and we only have a couple $1 million of capital in the fund, doing a vertical slice is going to be pretty easy to do, particularly given these very high exemptions. Now, if, I'm a founder of a fund that's been in place for a while, and let's say now I've got, $200 million of capital invested in the fund. If I'm doing a vertical slice approach, and if I want to give away, let's say 50% of my carry, under a vertical slice approach, I have to give away $100 million of my LP capital. And if I only have a $13 million exemption, that's not going to get me very far. Now, you can do some leveraging and things like that. But, the point is that, when the capital interest in the fund gets to be pretty meaningful, pretty significant, that puts some natural limitations on the vertical slice planning, in the absence of writing a check for 40% for gift tax. And so there are some other strategies that we've come up with over the years called non-vertical approaches, which are probably beyond the scope of today's planning. But just know that there are some other ways to kind of skin the cat. Again, I would say all of these, whichever is going to be the best fit, depends upon, the comfort level of the client, the appetite for complexity versus complexity versus, lack of certainty. and a number of other factors, right? There are evaluation issues and things like that that need to be worked into the analysis.
Of course. And Todd, I'm going to, in about a minute, give you a chance to maybe do a close and also have an opportunity to share how families and family offices can reach out to you. I will do, and then I'll close as well myself. Just a final reminder, this is simply for educational and entertainment purposes. This is not advice. You need your own advisor that's going to be specific to your specific situation. You may be hearing this at a time, and it's just not evergreen anymore. Rules and regulations changed. Your condition is unique. So if you hear this at a different time, it simply is going to have a different context and not be as applicable. Again, for educational purposes at this time, subject to a level of interpretation, and for entertainment purposes. Think for yourself, do your own diligence, and at the end of the day, make your own decisions. Todd, I'll give you a chance to conclude and share how people can reach out to you.
Well, Angelo, thanks so much again for having me. It's been a lot of fun. Like you're saying, it's actually been very entertaining for the two of us to do this, and a nice way to sort of wind down our week before the Thanksgiving holiday. I think the takeaway from our discussion today, we've covered a lot of different topics, right? It's a lot of overlapping, floating issues, and they all sort of are ingredients that go into sort of the soup, if you will, right? But I'd say, for all the planning that we see out there, my advice is not to go out and just say, well, we want to do this entire structure and just boom, do it. These are things that evolve over time, right? I think, whenever I'm looking at an existing structure, what I'd like to do is say, okay, this is good. This could use some tweaking, or some fortification. This thing is kind of festering. We should think about maybe unwinding that. After you do your sort of base level stress test, your analysis, right? Where else can we add to that? Where else can we build on the structure? Where else can we add additional octane into the structure? And it's going to be an ongoing thing, right? A lot of times the most efficient structures build upon the existing and then build upon the existing and see how we can make it more efficient. A lot of times my focus on that efficiency is the multi-generational sort of elongation of the family wealth preservation, right? I think there's usually a lot of places that can be improved. There's usually a lot of places where some fortification can be very helpful. And, there's often some cases where there are some things festering that need to be sort of fixed or maybe perhaps even removed or eliminated from the structure. But, again, I think if you focus on sort of building upon these, a constant evolution of doubles and singles over time, you can have a quite powerful structure and make it even more efficient. So again, I'm at McDermott, Will, and Emory. If you want to reach out to me, you can reach me at 212-547-5696 or mwe.com. And my email address is T Angkatavanich. So TANGKATAVANICH at mwe.com. And I'd be happy to chat with you. And Angelo, thanks so much for having me. It's been a lot of fun, and happy Thanksgiving to you.
It's always a pleasure. I'll give a brief close from my perspective. I really enjoyed today's conversation. I've known and respected Todd for so long. It's been a great honor to interview him. And really, the issue of estate transfer and estate planning, really going back decades for me, is kind of my first love broadly in the world of wealth and also in family offices. I know it may not be quite as exciting as investing in some of the other dynamic processes and opportunities that are out there, but this is so important. And that led me down the road to being more fluid on economics, geopolitics, broadly investing, obviously tax issues, and really the holy grail for me was understanding the importance of family governance and stewardship, and then tying that all together. So this was an honor to do a conversation like today. In some ways, we touched upon very complex subjects in relatively a short time frame without taking one and really breaking it apart. That may be the subject of a future masterclass. So who knows what that may hold. But obviously I would recommend reaching out to Todd. But in concluding my comment is, unfortunately, I feel that much of the family office world is effectively superficial. It's effectively glorified events, often with conflicted speakers. And there is a lack, in my opinion, often of more institutional level focus and rigor, and really a focus on intellectual best practices and how families could be generational, how family continuity could be procured, and the importance of the incredible value, in my opinion, that a single family office that is done right or could be adapted to be better via best practices. And that really led me to create my core anchor company, SFO Continuity. And within that, my family office masterclass, my family office playbook, and resources for those that qualify to be a member of SFO Continuity certainly have an opportunity to reach out. But the masterclasses and my playbook are effectively also available in one-off situations as well. So simply go to angelorobles.com, have an opportunity to reach out to me, follow and subscribe on all my YouTube and LinkedIn and all social platforms. I do love, primarily on Family Office TV, which I own, to kind of give away great content for free. That's fine. But to get a level of the hand-holding, a level of the in-depth, and the value of being part of a special community, you really have to join and participate in terms of what I'm doing. And follow me on this journey from more of an intellectual perspective and best practices. That's no offense to others that are out there that within their own way do a good job. But again, I've been in this industry for decades. There, unfortunately, is a lack of more of a comprehensive, rigorous approach that is anchored around policy and procedures, around processes and best practices of the best in all the verticals that correlate into broadly the family office. It is a lot more, trust me, than just investing. So on that note, I think by now you all know how to reach out to me. I thank you all so much for listening or viewing in to the program. I appreciate it. Todd, it certainly is great to see you. And on that
Likewise, for sure.
I will say goodbye, but I thank you all. Very much enjoy, hopefully, a great end of the year and a great holiday season, and look forward to seeing many of you the remainder of this year, but certainly, of course, into next year as well. Big plans 2024 will be amazing. Thank you all so much.